Welcome, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the show, my guests and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that affects our local real estate markets will be covered here. If you got credit issues, you can call me. If you're looking to buy or sell your home in today's market, you can reach out and call me. If you have any questions, whether it's regards to, getting your credit fixed to buy your home, whether it's, you're unsure about the mortgage market and whether you can get qualified for a mortgage, or whether you're going to have to rent instead for the next 6 months to a year and not able to take advantage of the low interest rates. You've got questions and I've got the answers. Make sure that you join us every Monday at WNEW 1580 AM from 2 to 3 p.m. in the afternoon. And if you have any questions or concerns or real estate needs, the best number to reach out to me at the off-air number is 877-245-2030. That's 877-245-2030. Or you can visit us via the web at realestate360live.com. That's realestate360live.com. Remember, if it's real estate, guys, it's covered here. Joining me on our panel today to discuss the many topics. We've got a huge week this week. It could be very, very volatile as far as interest rates. A lot of stuff going on overseas in Europe, as well as the Fed statement coming up. Is Louis Cammarosano, who is the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. Like I said, we're going to discuss with you guys about what happened last week in the markets, as well as what's on deck this week that can affect you and your real estate decisions. Louis, how you doing today, buddy?
I'm okay, Ryan. How about you?
I'm doing pretty well. I know we have a huge week. This might be one of the biggest weeks that we've had in some time, Louis. As far as, obviously, we've got the Fed meeting. They meet on Tuesday. And Wednesday, Wednesday afternoon, they will issue their policy statement. But last week, we had where I believe it was Draghi, which is the European and Central Bank's president, came out and basically said that he's going to go to any length to save the euro, which what that did was it effectively took a lot of money out of the safe havens of bonds and put them back into the equity markets, which actually shot interest rates up a little bit. Now, they didn't go shooting out of sight. They're still extremely low, but I think that this is something to worry about if they continue to perceive that what's going on over Europe, they're going to be able to save the euro, which they meet, I believe, this Thursday, right after the Fed makes their decision on Wednesday what they're going to do. The European and Central Bank's going to meet on Thursday. At what time, I believe, Draghi's going to have to he's already acknowledged they're willing to save, so he's going to have to come out with a strong statement acknowledging that and what he's willing to do. If that happens, I can foresee that the mortgage markets could be extremely volatile up and down. The markets right now are anticipating, they're baking it in, that the Fed is going to do QE3. Now, will they choose to start that as of the Wednesday policy, or are they going to push that to the next September meeting? That's the only thing we're unsure of. And it's quite curious as well because on Friday we actually have the jobs reports. They're actually going to be making this decision prior to knowing what the jobs number is. Now, I would say that they probably are aware that the jobs number is going to come in pretty, terrible, like it has for the previous 6 months, and they already know that the market is anticipating that they're going to do something. So if they don't do anything, then it's going to be letting the markets down, which in the last 6 months, Louis, it seems like the Fed is just really there to try to keep the markets somewhat tame. What is your outlook on this Fed meeting, and do you think that anything constructive is going to take place?
The answer to the second question is no. What will probably happen is I think they'll hold off on doing anything, although what they really should do, if they had the U.S. dollar at its best interest, they wouldn't do anything, and they'd wait for Europe to make some type of statement the following day about how they're going to print more euros to save the euro. But you know that they coordinate their decisions, so it's possible that they won't do that, and they might do some type of announcement. But I think they won't. I don't think to do something now would signal some type of panic or weakness that the economy really hasn't turned around. It would also look like they were trying to help the president's re-election campaign. And frankly, this is the reason why they're not taking this reason into account. It won't do any good, and it will do more harm. I just think they're delaying when they do more QE3 just because they need to do more just to keep interest rates down.
Yeah, I totally agree with you there, Lewis. I do think that it is a move that is, could signal that there is more instability than the media is leading on. However, it almost seems like the more and more I've been watching TV that they feel like that they have to do this. And it seems like every time that the media really starts pushing this, the Fed at some point steps in and does make the move. So I am a little concerned. And for the premise of our show and really letting people know what's going on out there this week, I mean, any of these things don't go as anticipated. The mortgage market, the interest rate environment could change, and it could change drastically. So I really want to emphasize that, if you're in the midst of a transaction right now or you're contemplating whether you're going to lock in your interest rates, that you probably go and do that as soon as possible. Take all the risk out of and the guesswork out of what's going to happen over in Europe, what's going to take place in the Fed meeting, and also what's going to take place from the jobs report on Friday. There's just too much news that's taking place this week that could really push interest rates one way or the other. Technically speaking, the U.S. interest rate markets are trading at critical levels, meaning we had hit down at extreme lows. Last week, it seemed like we got a bump back with Europe, Draghi coming out and saying that he'll do whatever they can to save the euro. So equity markets bounce back up. Mortgage interest rates actually got a little worse towards the end of last week. So I'm a little bearish. I really feel like it's important to go ahead and secure your interest rate before all of this news takes place.
I agree on, because regardless of what happens this week, next week, and the next few weeks, it is 100% unsustainable that they can keep these interest rates this low. And the rates will be higher, and you're much better off being safe and locking in your low interest rate long term if you have a home that you want to buy and you're able to purchase it and you're going to live there for a while. It really makes sense to lock in that long-term interest rate. Because as you know, look what happened in Spain, Greece, and so on. Once investors focus in on a country's bad credit, it's over for that country. They lose faith, and interest rates shoot up because that's what the sovereign has to pay. And the United States is benefiting from the fact that it's the world's reserve currency. It's the largest ship in the pond, and everyone's worried about the other sovereign's inability to pay, and they're taking some fake comfort in the fact that the United States can print up the difference. But eventually, that's not going to hold water, and people will start to move into other assets and other safe havens to put their money, and interest rates are going to have to rise. At that point, now you've lost the ability to lock in a long-term interest rate, because once they start to go up, they'll continue to go up.
Yeah, and they do move quickly.
And the reason they need to go up is when they go up, then the United States has to stop spending and stop borrowing.
Right.
So that's how we fund our deficits, is through the issuance of these bonds at these low rates. And right now, there's been no indication that we're going to stop spending the money. However, at some point, we do have to pay it back. And that number gets bigger and bigger with annual deficits over $1 trillion, and the overall deficit being $16 trillion, and then the unfunded liabilities being the hundreds of trillions. The United States cannot pay back what it's borrowed, and it continues to borrow more money in order to pay back the interest payments of what it's already lent out. And that's why they're trying to keep interest rates low, but eventually no one's going to buy that, or fewer people or fewer sovereigns or fewer investors are going to buy that story, and interest rates are going to have to rise. Your mortgage is going to go up.
Absolutely, Lewis. You're listening to Real Estate 360. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano. It's interesting because that's the question that I get from a lot of listeners, Lewis, is, okay, well, when do you think that time's going to come? And unfortunately, it's not very easy to figure that out because, there was an interesting article by Matthew Graham, I believe this was on Mortgage News Daily, that he talked about the way that we used to be able to take economic data and statistics and figure out what was going to happen with the mortgage market, the interest rate, and also what was going to happen with the equity market. So you take a jobs report. If it came in better than expectations, then, you obviously the stock market would rally, mortgage rates would get worse. Well, now we're at a point in time where all of those individual economic reports don't really mean anything, and people are actually looking at how those reports are going to either push the Fed to want to do something or not do something.
Right. You're not looking at a market that is driven by market forces. You're looking at a market driven by central banks and what they're going to do.
Yeah, and
those decisions are more based on what's in the interest of the banks and what's in the interest of the politicians, rather than just basic fair value, because you know that for money to be lent out at these current inflation rates, 1% would not be what a borrower would have to pay. They're only that low because of central planning, because you have one Federal Reserve chairman who actually fixes the interest rates. And if that was, they're complaining about the LIBOR scandal, that they've been fixing rates illegally. Well, what does the U.S. Fed and what does the European Central Bank do when they fix the money supply or increase the money supply or set interest rates?
Yeah.
Those are not market-driven pieces of data, so why would you expect to be able to analyze the market by market data? You analyze it by what the Fed does or what by the ECB does.
Yeah, I mean, and realistically, like we speak week in and week out, interest rates are phenomenally low. They're great. And, is it going to continue in this low interest rate environment for an extended period of time? More than likely it will.
Right, they shouldn't, but they will. And that's just something for our listeners to keep in mind is the analysis that Ryan and I give is based on how markets review credit risk.
Right.
We know that the market is not driven by normal lending standards. It's driven by what the Fed does and says.
Yeah, and in order to manage and keep going down the path that we've been going for the last couple of years, they have to keep interest rates low. They won't even be able to pay back the debt. So, that's why more than anything else, I feel like this is going to get extended for an extended period of time, regardless of what happens in Europe. We're going to probably maintain our status as the reserve currency of the world. And with that being said, this could be a low interest rate environment through, 2015, 16, 17. We're really unsure. But what Lewis and I are stating that at some point this is going to be detrimental to our country because inevitably when inflation does rear its ugly head, which at some point it will, there's going to be a lot of people going through a lot of heartache at that point in time, especially if you haven't secured your 30-year fixed mortgage at sub 4% interest rates, depending upon your qualifications. You're going to be paying extremely high rent. More than likely, this is my opinion, but more than likely you're going to be it could be double what you're paying now.
Well, if you look at it, Ryan, right now, after a financial crisis, when you had the expansion of credit, we should be in a very deflationary environment right now. The only reason we're not, and we are in an inflationary environment, is because of the increase to the money supply and the attempt to increase credit through the acts of the Federal Reserve.
Right.
So what they're doing is they're not allowing the prior boom to run its course and go through the bust period. They're just keep reheating the souffle. So when that happens, we're getting these artificially low rates when rates should be higher.
Yeah, I was listening to, I can't remember if it was CNBC or somebody this morning, and they said that maybe what the Fed will do this time, instead of just going out there and buying up more mortgage-backed securities or more treasuries to continue have interest rates go down further, they might actually go to the banks and make it so that they don't have to have as much excess reserves on their balance sheet so that they can take that money and lend it out to more people. And I started laughing because I'm like, great, so if you allow them to have less reserves on their balance sheet, it just creates more room for them to go out and take risky bets in the equity markets.
Well, that's exactly what happens when you increase the money supply and you lower credit. You give a false signal to the market that you can go out and make investments.
Right, because they're not going to want to sit around and lend to a business, at 5 or 6%. They deem that super risky. They'd rather go out and try to play in the market. In which cases, a lot of the times they're able to hedge their bets and may have some sort of arbitrage situation where they're going to make money one way or the other.
And it's the same thing with individual investors or savers. If there's no return to be had on interest rates, you have to put your money into more risky assets, which is the stock market. Or you could buy real estate or gold and silver, but the vast majority of people don't control their own finances. They have their money in 401k plans, and where do you think they put the money? They don't buy real estate, gold, or silver. And therefore, the liquid assets end up not being saved, but end up being thrown into the stock market, which we mentioned prior, raises the stock market valuations, which gives a false sense that the economy is doing well, but it may not be.
Yeah.
It's really just the stock prices are going up, but there's not really an underlying basis for it. It's just that they've created the demand by keeping the interest rates low.
Yeah, absolutely. I'm 100% in agreement there. We're over 13,000, I believe, today. I really don't think that that's an indication of where we are as an economy. We're coming up on a break. When we come back, Congress poses a new HARP-like refinance plan. Will this help you potentially refi? I'll let you know when we come back. Stay right there.